If you've already used the safe wheel, then you've seen what a rules-based system can do. No guessing, no directional bias, and only 15 minutes a week. But what if I told you the next step in your evolution as a trader breaks every rule you've been taught about selling options? It opens for a debit. It starts with negative theta. The market barely moves, and it still closed for a $7,500 profit. This isn't luck. It's what happens when you understand how to apply second and third order Greeks correctly. The part of options trading almost no one talks about. Most traders would have skipped right past this setup. They're trained only to look for positive data, high probability credit spreads, and obvious market direction. But this trade did the opposite. It was open for a debit. It started with negative time decay. And the market, it barely moved. Yet 30 days later, the trade closed for a $7,500 gain. Why? Because the real edge didn't come from theta or direction. It came from something deeper, something most traders never use: second and third order Greeks. Most traders focus on delta, theta, and maybe vega, but those are just surface level Greeks. Under the hood, there's a whole different layer. You've got gamma, how fast your delta changes. You've got Vama, how your Vega reacts to changes in implied volatility. You've got charm, Vana, speed. These are lesser known but powerful dynamics. And these aren't theoretical concepts. They're real levers you can use to design trades that profit, even when the market doesn't cooperate. In fact, the best trades I place are the ones that perform across all market conditions and are specifically structured around these hidden Greeks. And that's the secret. The reason most traders never discover this edge is simple. They're filtering out before it even shows up. They skip over debit trades. They avoid negative theta like the plague. And they rely on backtests or playbooks that ignore second order effects entirely. But here's the truth. These lesser known Greeks give you the ability to shape your risk curve, not just bet on direction or decay. And when you know how to combine them, you can build trades that win across all four market types, handle chop, crashes, and rallies, and adapt in real time without needing to predict anything. And you do it with full control over your exposure. Look, if you're trading without these tools, you're flying blind. The market is complex, but once you understand how second and third order Greeks interact, you can start engineering trades instead of guessing or reacting. And that's what I do inside my more advanced strategy. And it's not about trying harder. It's about seeing the game at a higher level where risk is shaped, not chased. Most traders are still stuck playing checkers, and this is chess. Now, if this sounds a little more advanced, good. It means you're ready to go beyond theta and delta. And if you haven't yet, the best place to start is building that foundation. And it's with my safe wheel strategy. It's 100% free, and it teaches you how to follow a black and white system that generates consistent results with minimal time commitment. No hype, no prediction, just process. And you can grab it using the link in the description below. And if you already use a safe wheel, then you're closer than you think to the next level. The level where understanding the real Greeks gives you the trades that break all the rules and still win. If you want to know the exact trade I used to make the $7,500 profit that broke every rule, then watch this next video here popping up on the screen.